Hello everyone. Today we are going to discuss about the financial stability report of December 2025. Financial stability report is a biannual report published by RBI, and financial stability specifically came into fore after global events such as the global financial crisis of 2007. So let's begin. So financial stability is defined as the ability of financial system to facilitate and enhance the economic process, manage risk, and absorb shocks. This is the definition given by IMF. Now, if you see the interconnectedness or network among the financial institution of a financial system, then you will come to know what is the systemic risk or say a financial stability risk within that financial system. So, in Indian scenario or even in a global economic scenarios, there are various financial institutions such as a mutual fund, AMCs are there, insurance companies, public sector banks, pension funds, urban cooperative banks, foreign banks, small finance bank, AIFI, HFCs, private bank, and NBFCs. These are the major players or financial institution among the financial system. So if you see the interconnectedness of or network of those financial institutions, in this given graph, September 25, you come to know that the mutual fund houses they had the net receivable position of around 21.5 lakh crores, means they are the largest fund providers to other financial institutions. Whereas if you talk about NBFCs, they are the largest fund receivers in the financial institution. So this is a tightly woven network of financial institutions. It's not that this is the net receivable position. They have receivable and payable position both. So in this graph, what you are seeing is a net receivable position. And coming to the instrument through which the funds are received or funds are provided, the major instruments or financial instruments are equity instruments, your loans and advances are there, then debt instruments are there, certificate deposit, commercial paper, short-term loans, and short-term deposits. Those many instruments are there. Or among those top two, if we talk about them, it's equity instruments, and then comes loans and advances, and then comes debt instruments. So these are the top three instruments through which investment is made or resources are mobilized. So as we discussed, the asset management companies, mutual funds, they are the largest providers of fund that had net receivable position of 21.48 lakh crore as on September 2025. More than half of the funding by AMCMF continued to be in the form of equity holding. Funding through certificate deposit, long-term debt, and commercial paper marginally decreased over the position a year ago. Scheduled commercial banks, especially private banks, remain the major recipients of funds from AMC, MF, followed by NBFC, AIFIs, and HFCs. Now, if we talk about the insurance companies, they are the second largest providers of fund. They had the net receivables position of 11.60 lakh crore. Insurance companies provided fund mostly through long-term debt and equity instrument, which accounted for around 88% of their receivables. And the scheduled commercial bank, again, especially private banks, they were the largest recipient of their funds, followed by NBFCs and HFCs. NBFCs, they were the largest net borrower of funds from the financial system. More than half of their funds continue to be sourced from scheduled commercial bank, and then it is followed by insurance companies and mutual funds. Housing finance company, they are the second largest net borrower of fund from the financial system. And again, the scheduled commercial bank continued to be the top fund provider, although their share was seen to increase with corresponding decrease in funding from mutual funds and insurance companies. Now, coming to the interesting case of AIFIs. AIFIs like Exim Bank or NAFED or National Housing Bank. So they had a gross payable and receivable position of 10.02 lakh crore and 7.85 lakh crore respectively. So in total, they had a net payable position of around 2 lakh crore in September 2025. While the AIFIs raised funds mainly from scheduled commercial bank, mutual funds and insurance companies, they were observed to lend to scheduled commercial bank predominantly. Means if you see this graph, you will see that the top three lenders, those who provide funds to this AIFIs, is the top lender is scheduled commercial bank only. Means around 59 or say 60% of their fund is met by scheduled commercial bank. And this fund interestingly goes back to those public sector. So it's more of a tripping of fund between banks and AIFI. So that's why this is more of an interesting case of how the funds move from this AIFI to bank, and again from bank to AIFI. This refinancing or say garnering of fund, say RIDF scheme is there. So banks they deposit fund in institution, a financial institution, whereas the financial institution will do the refinance of the same bank. So it's more of a movement of fund that's make this a very interesting case. So in terms of intersectoral exposure, as we discussed earlier, AMC mutual funds, then insurance companies and public sector banks, they remain the largest fund provider in the financial system, while NBFCs, private bank and housing finance companies were the largest receiver of funds. The total bilateral exposure, if we talk, it was 85.7 lakh crore, which is a 20.1% growth from the same figure of September 2024. So this was important interconnectedness or network analysis, which is given in the financial stability report. Now we talk about the outlook, which has been given in the financial stability report. The global outlook says that it was global outlook was surprisingly held up in a better position. I mean, even though this U.S. government turmoil or imposed tariff decision that has been there, so most of the trading partners and prolonged global economic and trade policy uncertainty they were there. In spite of that, it has uh, surprisingly held up in a better position. A combination of front loading of trade, then alacrity in finalizing the bilateral trade deal, in the fear that tariff may be imposed. So trade deal they were struck in advanced mode, and huge AI related investment has contributed the global growth resilience. Accordingly, the IMF revised its 2025 global growth projections upward from 2.8 to 3.2%. Now, coming to the domestic outlook, our Indian economy remained robust despite unfavorable global headwinds. The real GDP growth, if we talk about the quarter one, it was 7.8%. For quarter two, it was 8.2%. It was supported by private consumption and public investment. So private consumption is around 61% of whole GDP, for which government has taken so many decisions in the form of tax reform, GST, your income tax reforms that they have been there. So because of that, private consumption has remained strong. Now, growth outlook remains positive, aided by low inflation. Inflation has been tamed to a great extent. Easy financial conditions, above normal monsoon, direct and indirect tax reforms, and ongoing expansion of digital public infrastructure. So, because of these initiatives, our growth outlook has remained positive. The RBI has also revised its GDP forecast for year 25-26 upward from 6.8 to 7.3%. Now, if you talk about the digital public infrastructure, which we discussed in the previous slide, so what is the digital public infrastructure? It's mainly related to the using the digital platform for identity, for payment activities, for data activities, such the infrastructure is for identity. The infrastructure is Aadhaar infrastructure, that is Aadhaar services are there, Aadhaar enabled payment system is there. For payment you have UPI, who is operated by NPCI. UPI platform is for payment or settlement infrastructure is also there. Then for data you have accounting aggregators, which is of course if it is an NBFC it will be regulated by RBI. Then for credit you have OCEN, Open Credit Enablement Network, that is there. ONDC, Open Network Digital Commerce, which is a substitute to network like Amazon and Flipkart. So Indian government or India has been taking so many initiatives to strong our digital public infrastructure. Now, digital this financial stability report of June 25 gave a basic number that what will be the impact on our economy if there is a global turmoil. So if a 100 bps slowdown is there in the global growth, it will pull down India's growth by 30 bps. So it was more of an interesting fact. That's why I put it here. GDP growth trend, if you see in the financial year 20, it was 3.9%. In 21, it was negative 5.8 because of the COVID impact. In financial 22, 9.7%, highest in the last 6-7 years. Then financial year 23, the growth was around 7.6%, and then in 24, 9.2. And financial year 25, its provisional estimate 6.5, and 26 advanced estimates are around 7.4% growth is there. Now, coming to the deposit and credit growth for banks, that is the most relevant portion of the financial stability report. If you see, the deposit growth is 9.8% for all the scheduled commercial banks. If really private banks or foreign banks, the growth has been same, that is 10.1. For the public sector bank, it was around 9.1%. Whereas credit growth for September, for March, uh, March 25 was this 11%, and for September also it was 11%. Means the credit growth has remained intact, whereas the March deposit growth was 10.7%, which is now 9.8%. So you see, your deposit growth is lower than your credit growth. So as a result, your credit to deposit ratio is increasing, and that is a worrisome situation. So the credit to deposit ratio has increased from 78% in September 24 to 78.9 percent in September 25. Means it has increased by 90 bps. Importantly, the increase in CD ratio is driven by the substitution of funding from the deposit with an increase in equity capital. So banks, they need deposits so that they can advance some loans. So if they are not able to garner deposit from public, they have alternate sources of funds, and they have substituted that much of deposit from the equity, and that's why they have been able to lend, and as a result your CD ratio has improved. As you can see in this chart, the deposit growth has been in negative, whereas the equity capital, the growth has been substantial. Means a major this slump in deposit has been, to a great extent, has been mitigated by raising equity share capital. Now, recently, this December, if we talk about the December data, your CD ratio is climbed up to all-time high of 81.75%. So, which indicates there is a pressure on lenders to shore up deposits amid a rising loan demand. The ratio means banks lent 81.75 for every 100 rupees of deposit mobilized. While the RBI does not prescribe a cap, it has urged lenders to maintain adequate liquidity buffers to meet unexpected withdrawals. Typically, out of 100 in deposit, banks set aside rupees 3 for CRR, rupees 18 for SLR, and around 3 to 5 rupees for this requirement of liquidity coverage ratio. The amount available for lending works out to around 75 to 76 out of deposit. Means it works out to 75 to 70 after meeting your CR, SLR, and LCR requirement. The elevated CD ratio reflects challenges in mobilizing deposit as investors seek higher returns elsewhere. Small savings scheme, if you talk about that scheme, they are generally providing 7.1% on 3-year deposit, which when compared to the banks are only providing 6.4% to 6.1. Means deposits are not that much attractive to the investors. The challenge intensified after RBI cut its policy rate by 125 bps since Feb 2025, prompting lenders to reduce deposit rates. The weighted average rate on outstanding term deposit fell to 6.73, which is the lowest since September 2023, while fixed deposit average is 5.59, the lowest since October 2022. Deposit mobilization has lagged the credit growth. Bank credit rose 11.4% in 25, while deposit grew 10.1%. Housing deposits were around 248.5 lakh crore, while the credit was 202 lakh crore as on December 31. To overcome this challenge, the bank will have to explore alternative sources such as bond issuance to finance credit growth. The pace of investment in government security has slowed, implying banks are deploying their fund for lending. Fresh investment in government security dropped to 1.87 lakh crore on year-to-date basis until December, compared with 4.89 lakh crore in same period a year earlier. The investment in the GSEC has went down because the yields, they are going up. So existing investment, you see that there is a chances that valuation loss will be there if the yield keep on going up. Or the banks, they are of the opinion that the yield will further go down, and at that time uh, they will be able to sell it. So because of these situations, even the rupee is depreciating, so the yield is not beyond the control of the government also. So because of that, they are not deploying much of the fund in government securities. They are mainly deploying it in lending activities. Banks have asked the RBI to include bond borrowing in the CD ratio calculation, which would help bring in it below 80%. Currently, only deposits and certificate of deposit are considered for computing the ratio. Bank officials are of the opinion that ideally a broader denominator should be looked at that includes borrowing and own funds when calculating the CD ratio. So this is a major issue which the banks are facing. That is more of a deposit mobilization, which can be inferred while seeing the CD ratio. If CD ratio is higher, means there is a credit demand, but there is not much deposit which are mobilized to fund that credit growth. Coming to NBFCs, the credit growth has been 20.70% in March 25, which increased to 21.3% in September 25. So the growth has been remarkable. Whereas for microfinance institutions, the growth has been in negative 17.5%, considering the quality of their portfolio. Uh, the credit growth has not been there, but they are more focusing on the recovery measures. Now, key highlight of the financial history report about the asset quality of this scheduled commercial banks. The gross NPA is 2.20%, net NPA was 0.5, your provision coverage ratio was 76%, slippage ratio was 0.7 times, your CRAR was 17.2, leverage was 8.1, LCR 131.7, and NSFR was 124.7%. Now, slippage ratio means new accretion to NPA is share of standard advance at the beginning of the period. For example, at the beginning of the period, your standard portfolio was 100. Now, at the end of the period, your standard portfolio was that the same portfolio was 95. Means the slippage of 5% was there. Means your that standard advance is turned to NPA during this half year period is 5%. So this ratio shows that the half yearly slippage ratio was 0.7% in the scheduled commercial banks in India. Liquidity coverage ratio is defined as the ratio of a high stock liquid assets on the total net cash outflow over the next 30 calendar year. So it will say that they have enough liquidity to manage their liability, which is going to accrue in next 30 days. Net stable funding ratio is defined as the ratio of available net stable funding to required net stable funding, that should be at least 100%. Whereas liquidity coverage ratio, sorry, leverage ratio is ratio of tier one capital to total exposure. This is a substitute to the CRAR measure because it doesn't take into account the risk weight. So minimum leverage ratio shall be 4% for DCs and 3.5% for other banks. Coming to the quality of large borrowers are defined as a borrower who have banking exposure of 5 crore or more. So large borrower, they had a gross NPA of 1.6% only, whereas the banking system, the gross NPA was 2.2. So large corporate borrowers, they had gross NPA of lower than the banking average 2.2. The share of large corporate borrower, if you see in the whole this exposure, is around 44%, but their share in NPA was just 33.8% on September 2025. So coming to the macro stress test, it showed that under the baseline scenario, the CRR may dip to 16.8 by March 27 and 17.1 by September 25. Uh, and gross NPA may improve to 1.9% by March 27 from 2.1 in September 2025. Coming to earnings and profitability, scheduled commercial banks, the cost of fund, average cost of fund was 5.6%. Yield on their advances was 8.3%. NIM was 3.3%. Return on equity was 12.5. Return on asset was 1.3%. So interestingly, if you see the public sector banks, they are offering higher return on equity as compared to the private bank. But still, if you see our first slide in the interconnectedness, you will find that AMC mutual funds, they are investing more in the private banks as compared to public sector bank, even though the ROE offered by public sector bank is higher than the private banks. Now, coming to NBFCs, the combined credit growth has been 21.3. Borrowing growth in upper layer is 46.4, whereas in mid layer is 13.2. Their CRAR is 20.3 and 27.9 for those NBFCs respectively, and you can see other important metrics in this table. Now, coming to their major sources of fund, you will find that major sources of fund for NBFC will be mainly bank borrowing. Then, from this table, you will find that debentures is the second major source of fund, and then comes your commercial papers. Then, public deposits are also there, provisions and other liabilities. So, these are the sources of funds for NBFCs to further on lending. Now, sector-wise gross NPA, if you see sectoral insight, you will find that for the agriculture sector, the gross NPA was highest, 6% for industries 1.9, service 1.8, and for personal loan, it's lowest 1.1. But among personal loan, you see the GNPA for the public sector bank has been 15.2% as compared to the other financial institution, which has been very high. So it's mainly maybe because of that recovery mechanism which is deployed by those private players, which is not in the case, which is not the case for public sector bank. However, gross NPA is more or less same for the public as well as private players. Now, coming to the industrial subsector, the highest gross NPA has been found in your food processing industry. Then your textile industry has also gross NPA of 3.5%. So these are the top two industry. If we talk, the food processing has a gross NPA of 4.4, the textile has a gross NPA of 3.5%. In the microfinance sectors, we see the credit to the microfinance sector declined for the sixth consecutive quarter with 9.3% fall in half year 2025-26, with the total active borrowers in the sector decreasing by 78 lakh. Asset quality is showing signs of improvement with the ratio of stress asset decline in three consecutive quarters. Insurance sectors, the insurance penetration of India has declined. It has gone down from 4.2 to 3.7 in from 21 to 25, whereas insurance density has gone up from 78 to 91 from financial year 21 to 25 respectively. Insurance penetration is your ratio of insurance premium to country's GDP, whereas insurance density is the per capita insurance premium. If you see the AUM of a pension fund, the largest deployment of a pension fund is in government security. The AUM of pension fund as of September 25 was 15.80 lakh crore, whereas for insurance company the AUM was 74.44 lakh crore. And again, the largest deployment was in government securities. Then came equity and mutual fund, that is around 22%, and around 15% is in corporate bond. So, if we want to address the issue of infrastructure financing, because the ALM gap has been there, mismatch has been there, which is not much in the NBFCs, but more in public sector banks. So, they may garner funds from such insurance companies or this provident funds to address the issue of infrastructure finance, because they have generally higher gestation periods, higher tenure loans are there. So the liability may not be of that same period. So to address the issue, this thing may be considered, because as of now, there are major chunk of those insurance companies and pension fund houses that is going on government securities, equities, and corporate bond market. Now, coming to the government finances, India's fiscal dynamic remain healthy, supported by sustained improvement in the quality of spending with higher education for capital expenditure and commitment to fiscal consolidation. This was reflected in S&P Global rating upgradation of India's sovereign rating from triple B minus to triple B in August 2025. Moreover, India's debt remains sustainable because of the favorable interest rate growth rate differential and the low level of foreign currency liabilities. The high average maturity of the debt portfolio with very low level of floating rate liabilities together mitigating rollover and currency risk. The overall debt to GDP ratio remains at around 82%. This is largely due to elevated state government debt. Coming to the external sector, The stability has been a key pillar of India's overall macroeconomic stability. Despite a sequence of formidable external headwinds, the external sector has remained resilient, although the current account deficit (CAD) has widened from 0.3% in quarter one 25-26 to 1.3% in quarter two 25-26. It remains eminently manageable with buoyant service exports and inward remittances expected to offset widening merchandise trade balance. External balance stood at around 19.2% of GDP at the end of the year, September 2025. I hope this video will be of a help for all the learners who want to understand the finance or economy. Thank you very much.